Deflation and recessions. Many believe, particularly in government, that they are intertwined. To provide a balanced perspective on the many myths behind this economic pattern and phenomena, we will hear from millionaire investor, entrepreneur, and author Robert Kiyosaki, author and economist at George Mason University, Lawrence H. White, economist and investor Keith Weiner, and macro analyst and investor Lyn Alden.
Basically, the idea that we have to, through central decision making, keep people on a constant treadmill of consumption by discouraging their savings and trying to get them to go consume faster, I just think it's very misguided policy. I think the real reason that they don't like deflation is because the one thing it is not compatible with is tremendous amounts of debt. Their model's based on having a very highly leveraged system. And if you ever get kind of broad deflation, those liabilities start getting harder. Basically, our system only works when those liabilities are kind of constantly growing and constantly getting mildly diluted. I think that's ultimately the real reason. That's why when people hear deflation, they assume it's a bad thing. They think of recessions because that's in the modern context the only time we ever really see it. Whereas structural deflation's good. We like the fact that TVs and computers and phones are structurally cheaper now, especially on a per quality basis than they were 5 years ago, 10 years ago, 20 years ago. Like literally the most valuable sector in the world is the most deflationary one. You know, Apple's the most valuable company in the world, even though they sell a deflationary product. Every year, their phone gets a little bit better, especially on a per dollar basis. And people don't just say, well, I'm going to wait 7 years to get a phone. You know, sometimes you might push it out 3 months to get the next model if there's a model coming up. But, people need a phone. And so they go out and get a phone. People need a computer. They need a car. They want to live their life.
I think in general, there is not a deflation problem from having a fixed money supply. Because then you have deflation when output grows. So you have the same number of units of money chasing more goods. The price per good goes down. That's fine. That's how people enjoy a higher standard of living, by prices falling. And if you look at the history of the gold standard, there were periods in which that's an approximation to what happened. Prices were falling because output was growing faster than the supply of gold. That doesn't create any big problems. It doesn't create negative interest rates or trouble like that.
A big pet peeve of mine is this idea that the Fed is going to smooth out the business cycle. I encourage anybody to go put together or look at a graph of anything you want to pick, interest rate or otherwise, and take a look at from the inception of the United States, call it 1790 to 1913, and then take a look at the post-1913 reality, and then tell me which one was more stable. So my favorite chart to look at with the interest rate was amazingly stable. It had some blips when there were existential threats, the War of 1812, obviously the mid-1860s, some other, lesser things along the way. It was amazingly flat. And then after 1913, it all goes completely off the rails. And the people who manage the off-the-rails process have the nerve to say, look at how much more stable we made things because we've taken it off the rails. We've taken the interest rate down to absurd depths. We've taken it to the moon in 1981. But yeah, our system is somehow more stable. Mendacious, I'm sorry.
While our politicians say to you, we want to make sure you have jobs and all that stuff, what they're not telling you is for the U.S. economy or the economy of Japan or Europe or any place in the world to survive, it is better to have a weak dollar. So what that means to you, if the dollar is weak, that means our exports are cheaper, so the U.S. will export more. But what that means to you as the human being or the person living in the U.S. is by the government's policy of weakening your dollar, it means the cost of living for you goes up. If you're going to invest and the federal government, the U.S. government is going to weaken the dollar, that probably makes gold and silver more valuable.
I still keep saying to people, put yourself on your own gold standard or silver. I have a lot of silver eagles and coins because I want to be off the grid. I want to be off the Treasury and Fed and Wall Street. I want nothing to do with those criminals. I want to be able that I can spend my money freely. So this is money. This is toilet paper.
I would say don't sleep on gold. Just as gold today, having been demonetized, has a more volatile purchasing power than it did when it was a commonly accepted medium of exchange. But gold has the additional advantage of a long-run response in the supply, which stabilizes the purchasing power, and people anticipating that know that the purchasing power is not going to move too far. If the price goes up, they know that it's going to come back down, and that helps it come back down sooner.
Currency debasement is an odorless gas. It fills the room slowly, and by the time you notice, the damage is done. Sound money is built with assets that have scarcity, a long track record of trust and value, and cannot be printed by central banks. Policymakers, institutions, and governments may decide the fate of our currency. It's our responsibility to safeguard the wealth we have, because no one else is going to do it for us. If you are interested in protecting your retirement savings and preserving your purchasing power through a tax-deferred Gold IRA, see the links in the video description. To attend a free gold education webinar held by Augusta Precious Metals, see the link in the video description. Thank you for watching.